as owner, developer, operators, we're just running through walls and we don't care about that person or this person or how the organization's being run.
Talking to me.
And we did this for 5 years. We ran as fast as we could and at the same, not actually growing the business.
Mm-hmm.
And, I would say stop and make sure your business is functioning well.
Yeah.
Because if your business is not functioning well, your projects won't function well.
Welcome back to Ladders and Levers. This podcast is all about real operators, real deals, and real execution, not theory. Today, I am more excited than you can tell. These guys I've looked up to and very excited they're on the podcast. So today we have Mark Silver, Jordan Sachs joining us. They're the co-founders of Bold Partners, a multifamily investment platform that's been involved in thousands of units, large-scale value-add assets across multiple markets, and also behind the team, Sunday Capital, our go-to lender nowadays, is a transitional lending platform originating first liens, loans for acquisitions, recapitalization, and heavy value-add business plans nationwide. So I'm genuinely excited for this conversation because these are two powerhouse guys that I personally, like I said, look up to. And now Marissa and I are actually partnering with them on deals as they become our go-to lender and financing and lending partners. So this is going to be a very real operator discussion, which I'm so excited about. You guys are going to get tons of value. And through Bold Partners on the ownership and investment side, Sunday Capital on the lending side, they see deals from both angles as operators, as capital providers, which is rare perspective in today's market. So Mark came from Blackstone, where he was part of a placement team that helped raise over $220 billion across private equity, hedge funds, real estate funds. And Jordan co-founded Bold Partners, real estate brokerage, and a marketing firm that was successfully sold to Compass in 2021. And Jordan, I'm especially excited to dive into the execution side with you because from what I understand, you're very much in the trenches on the project and investment side, similar to how I operate, dealing with construction, timelines, contractors, all the headaches with cities, permits, tenants, and all the real-world execution headaches that don't show up on the spreadsheet. And we always joke that guys like you and me are living at job sites and handling the day-to-day execution pressure, while Mark and Marissa are behind the spreadsheets, underwriting, and being the so-called brains of the operation, keeping everything financially disciplined. So at GeoLiv, Marissa and I are hands-on operators, managing renovations, ADUs, tenants, and investor relations daily. So this conversation is going to be very real, from capital structure, investment control, a bridge debt, to execution pressure, which I deal with, and what it actually takes to deliver a business plan in today's environment. So Mark, Jordan, really excited to have you guys both on.
Thanks for having us.
Yeah, thank you for having us.
Oh,
great opportunity.
Yeah, you guys are, we can't be more excited to have you on. So we're going to just jump right in. So Mark or Jordan, how did Bold Partners originally start, and what was the vision in the early days?
I'll jump into the kind of how we got here. We started our careers back in New York in 2007. Just graduated college, trying to find our way. One of our other partner got involved. He was working at Marcus & Millichap at the time as an investment sale broker. And as a lot of brokers realized quickly, the other side of the table is a little bit more attractive. Short into that tenure, he came to Mark and I and said, listen, I think we should start buying some buildings.
Okay.
Fast forward 2008, we were in contract for our first portfolio on the Lower East Side. It was 6 buildings, 250 units, 10 retail spaces. And this was kind of... And at the time, it felt, in New York, that feels small.
Really?
These are tenement style, 25, 50-foot walk-up buildings, 1900s, 1910s. And this was early in the value-add game in New York City. And I like to think that we were kind of one of the first groups to really get involved. And this is kind of as the recession's, kicking in a little bit more. And we completed that business plan successfully, renovated 80% of the apartments, exteriors, interiors, repositioned the retail. And we found ourselves in a position not knowing how to lease our apartments. And we called some of the brokerages in New York and said, hey, listen, we have, 260 units, brand new, gut renovated, $90,000 a unit renovation. How do we get a real leasing platform? How do we get a marketing program? How do you treat this like a new development? They all said, we have no interest in doing that. We're built for new development. We don't really know how to give you the right resources. We were 25 at the time, and we said, and that market was paying traditionally a 1-month fee to a broker. So our average lease was $3,500. And we said, okay, well, instead of paying the broker the fee, we'll collect the fee ourselves.
Yeah.
And very quickly we realized, as we're leasing 4 or 5 apartments a Sunday sometimes, and there was an insane amount of money coming in the door from the leasing program. And we were also hitting our pro forma rents. And our pro forma rents at the time were probably 20-30% above market.
And just for your listeners, because this is a little unique to New York, we use a broker to rent the apartment. Right. So that's like a foreign concept for many people, because usually your property manager or you're on apartments.com, like everyone can understand that. But in New York City, there's a human actually renting the apartment. So when we're saying we're actually paying that 1-month fee or whatever, a human was getting that fee. It's kind of like buying or selling a house anywhere else in the country. That's actually what we were doing in New York.
Or like renting out a residential home.
Exactly.
Like a single, because you don't usually
It's
ever
uncommon
see.
in the United States. There's a few markets we actually do it a little bit in LA. That's one of the reasons.
We took that business plan to LA.
Yeah, but just so for your listeners, it's unique to New York.
New York's a much more disjointed, and the size of the properties are small, just like in LA. So having an on-site, having your management company create an on-site position for a 24-unit building just didn't make, from dollars and cents, didn't make sense. And we also found that those people aren't motivated to push rents, right? Our business plan was,
get it rented.
We were taking, a rent roll and trying to increase it by 4x. And you're not incentivized on a salary to do that, because a lot of the time it took 100 showings sometimes to get that unit leased.
Oh, yeah.
Wow.
And we were playing the rent roll game and trying to do quick refinances, and getting those rent rolls to where we needed to be was very important. So we realized quickly there was something to this brokerage thing. And, fast forward, call it 2009, close to 10, all the young guys were coming out of the institutional world with investors and wanting to go buy their own real estate.
Yeah.
So there was this massive influx of young value add developers buying tenement style buildings, but not really knowing how to do the business plan.
Yeah.
And so we said to ourselves, why don't we create a residential brokerage where we exclusively represent owners and developers in their multifamily properties, and we'll start from pre-acquisition and we'll take you through the completion of the business plan with giving guidance and our expertise, right? And at the end of the day, we will market and lease your apartment. So we get a call from an owner. He says, I'm walking this building, come with me. We walk it. We help him with the pro forma. We help him with the renovation specs, the floor plan renovations. And we take it as far as, we'll talk to your debt. We'll talk to your equity. We'll be on your team as a voice, as a cheerleader for the deal. And inherently, we really just want the exclusive rights to lease your apartment, meaning that a renter can't get around us. If you want to lease an apartment in that portfolio, we get paid that fee.
So that was all you got paid, though, was just the fee? You guys didn't charge like a consulting fee?
So we eventually moved into new development. So this grew. So, and I'm going to jump a little bit back and forth. We grew this business by 2019. We were doing 8,000 or 9,000 leases a year.
Okay.
So we were doing
a lot of leases.
Every new development that you can think, 1,200 unit new developments where we were doing, pre-planning. So I was sitting with my new development team now during SD and DDs and going through the drawings. And I would almost be there almost 2 years before we even started the marketing process.
Yeah.
Where we got paid a monthly retainer to do that work.
Oh, okay.
And then ultimately we made the additional money on the marketing materials and then the leasing.
And what areas were this? Just New York or both? California and New York?
This was all New York. So we were in
York,
all boroughs in New York, heavy in Brooklyn, Manhattan. And what this did for us on, now we're picking up the juices of we should be buying again, right? We've stabilized our first portfolio. We have this brokerage, which actually is lending a tremendous amount of operational efficiencies, information, due diligence, on the ground kind of knowledge, and let's turn that back into a buying platform.
Yeah.
And our way of doing it out there was we partnered up with other value-add operators, and we essentially developed a fund-to-fund model where we were going out, we were bringing in the LP equity, we were taking a piece off the GP, a piece off the LP, and inherently helping with the construction management, leasing, marketing, et cetera. And we did another 50 plus deals in that construct.
It was cool, like, looking back on it, just because we were seeing what everyone was doing, right? Like, so and
That's cool.
we sometimes say, like, New York City is like getting your master's in real estate because it's one of the
Yeah.
hardest markets to operate in, and
Yeah.
it's
Yeah.
really competitive. And we were sitting there with the best and brightest and best in class operators, helping them with their business plans, kind of doing what we're doing now, right? Where how do you get the value? How do
Yeah.
you lease it? Like,
Right.
and we were giving the script. Like sometimes I look at Jordan, and I'm sure you guys feel the same way. And sometimes we actually chat and say, "Hey, what does this even look like? Like,
Yeah.
if we spend $10,000, $20,000, $30,000,
Yeah.
like what are we gonna get in rent? Because
Yeah.
like that's what we all care about."
Yep.
So it was a cool little platform. And New York City's cool because unlike other markets, you know the entire market. So like I actually have a really good lens because they had things like Street Easy, which basically, if you have an apartment, you have the exact data of what that apartment says. So exactly what it rented for, what it rented for a few years ago, like in some of our markets, and I feel like California is one of them.
Yeah.
Like you could have a differentiation in rent between two buildings,
Totally.
hundreds of dollars, and you don't
Oh,
even
yeah.
know. So it was a cool platform and a cool market to actually kind of do it in.
That
So wait, what college did you both go to?
I went to Tulane in New Orleans.
Oh, okay. Are you from New York
So I'm from
originally?
Arizona originally.
Okay, I'm like, how
It
would-
didn't seem at the time many people got out of Arizona.
Yeah,
My
no.
brother went to Tulane, and he's 3 years older than me. And I went down there my freshman year of high school for Mardi Gras, and I immediately was like, oh,
Yeah.
I should figure out a way to do better in school and get myself here.
Yeah.
I went to Emory in Atlanta, and I was
Okay.
just happy to get out of Texas. I'm born and raised in Texas.
Oh my gosh.
And I was at Emory, and the thing at Emory was like go to Wall Street, go to New York. So it was like always
Yeah.
a dream to go to New York. But real estate's cool because it kind of makes you learn a city and kind of like
Yeah.
gets you involved in a city.
Yeah.
And so even we're not from California, we weren't from New York, but like when you're in real estate, it kind of feels like you're in the fabric of the city. So
Yeah.
it's cool.
And the comment that we got all the time was, oh, how'd your dad start the business?
Yeah.
Oh.
No, that's 100%. I was like,
our-
oh, did you go to
our-
NYU?
No, like our
how'd you,
feather in our
legalize it?
cap was like, we have no dad here,
Yeah.
and
Yeah.
we have no legacy real estate portfolio, and we literally have no family money, and we just
wow.
did our first deal. And
You're not part
Okay,
of the you're not
wait a
part of the
second.
Lucky Sperm Club.
no,
So
we were
then I have to
born
go
on
back.
home plate, trying to get back to home plate.
So now I have to go back because I totally just assumed you were. I mean, sorry to be
No.
prejudging you here, but how did you fund your equity then on your first portfolio if you guys were not from New York and not from all this money?
So two ways. It was probably not the smartest thing. A lot of leverage, like way too much leverage.
Okay.
Like talking like 90+%.
Wow.
And
Okay.
we called, like we all do, we called our network of like Aunt Susan and cousin Pam and the dads.
And by the way, a
gonna
bunch
ask
of 25-year-old friends that were
Yeah.
giving us $25,000 that meant a lot to them
Wow.
at the time.
And by the way,
Wow.
when we were doing our other projects, we started doing the same thing. So like when we were doing those other deals with the operators in New York, we were calling our friends still and
Oh my
saying, hey,
gosh.
it's an interesting opportunity.
Yeah.
We're doing the leasing, so we have a really good insight on what's going on with the project.
Yeah.
And honestly, like looking back on it, we didn't really know exactly what we were doing,
Yeah.
but you couldn't miss in New York. Like it was one of the best probably buying opportunities we'll ever see in our careers. I
Mm.
wish we knew more.
Yeah.
Right.
But now that we do know more, I realize this, and
Yeah.
Jordan probably thinks the same thing. Was like fishing with dynamite. Honestly, if you
Yeah.
bought a building, you could not miss.
Really.
In a market where rents just go up,
Oh.
and
Yeah.
and
Yeah.
you have a renter base that makes real money,
Yeah.
and a renter base that also can't buy single family homes because the average apartment starts at $3 million. For
But
them.
how did you get all those tenants out?
We had I would like to say an aggressive buyout plan, but I think we followed the law, right?
So it was like a cash for keys situation.
yeah,
and
it's
then
always been a
that's how you
cash
got-
for keys, whether we
Because
were doing
that's
New York
what-
or LA.
I mean, New York,
Yeah.
you think of rent control and you think of everyone staying in their apartments for 5 million years and never giving it up. So that's interesting.
And that was part of where we transitioned out of New York to start buying in Los Angeles
Mm.
was when those rent laws really dramatically changed under
Yeah.
de Blasio. That along with the institutional space, we were competing on a 25-foot walk-up with Blackstone.
Yeah.
And it became evident that we had this brokerage where we were really intimately involved with a lot of these owners and looking at deals off market and pre-purchase and all these things. And we were also buying on our own. And the space just felt like it was getting muddier and muddier, and it was time to go find a new market.
So how many deals or total units has Bold been involved in to date?
So in our careers, we probably have done over 150 actually transactions. thousands of units. We still own about 1,200 units in our platform. It's been really exciting. We've seen multiple cycles now. Like, so we went through the GFC when we first started buying.
Yeah.
I felt like there was a few cycles in between. We always saw what happened in COVID and the rate rise. So it's been interesting, but like we've been involved with a lot of transactions. I think we've learned a lot.
Yeah.
One of the cool things, I was talking to Jordan about this earlier, is that now we kind of have like a full circle picture.
Yeah.
Because we used to, like, we were brokers, right? We were kind of equity operators as well. Then we were just equity operators. And now on the debt side, we're lenders. And so I get to put my lending cap on a lot.
Yeah.
And Jordan does too. And it makes us better equity investors,
Yeah.
quite honestly, because we think about it in a completely different way. I like to think that as equity guys, we're internal optimists. Like, this is always going to work. And when I put on my debt cap sometimes,
it's never going to work.
We say the exact opposite.
Yeah.
Exactly. We say, this is never going to work.
Oh.
And when you think in those terms, but when you think in those terms as an equity person, that's a good way to think.
Yeah, totally.
Because like,
Protect
if it's going to, like, in your renovation, if it all goes wrong, and it's still okay, that's pretty good, right?
Yeah.
And so anyway, it's just an interesting way to think about it. I think it makes us better.
It's probably made us more conservative in
Yeah.
our underwriting. And I think that also comes with being involved in a couple cycles. It's easy to say that you're great at your job when the wind is in your back.
Yeah.
And I would be lying to say the wind wasn't in our back, specifically in New York. I mean, we round tripped all those deals in 4 years and returned everybody's money and made a bunch, everybody was really happy.
Yeah.
And that's just also part of the environment. Today, as you guys know, we've been out of that market for 4 years now.
Yeah.
The other cool thing is people are innovating. Like, we learn from you guys too. So like, we think it's cool when we're lending you money.
Yeah.
Because you're doing things we wouldn't do. And it makes us think and say, oh, that's really cool. They're thinking about it in a different way. So like, as much as we say this, and so it's cool that we're on this podcast doing this, we're partners, right?
Yeah.
Yep.
And that's one of the reasons why we do our lending, because we want to help folks that remind us of ourselves.
Yeah.
And so just as much as like we want to help you, like you're helping us too, because we think what you're doing is really cool.
Thank
I
you.
think a big takeaway from the lending side as an operator was do a little less. Like, we were really big on get in there and spend money and do it all.
Oh, that's
and
neat.
maybe that's also a function of the value add. The arbitrage is less and less as we go on here.
Yeah.
It used to be a lot more back then. But we look at like your business plan, then I go see what you guys are doing, and we go back and say like, listen, they spent, I'm just making numbers up, 12,000. In our mind, we would have spent 25.
Yeah.
Right? And you're probably going to get the same rents. So there was definitely, it helped us. It was a good lens to see.
Yeah. I feel like we spend, like, after talking to you and then listening to the other podcasts of the guy, the billionaire out here that Taylor had on.
Yeah.
Uh-huh.
Because he owns a bunch out here, and he bid us out on a building in Ventura. And hearing his podcast, and he's like, he spends like 20 grand or less. And I'm like, how?
Yeah.
But he's not doing substantial eviction remodels. So you can, if someone just leaves, you could get away with 20 grand.
Yeah.
Yep.
But you can't if you really want to turn a whole building. You have to do everything.
And we were buying very old vintage that required, it was essentially
it's
a
kinda
rebuild.
like
right?
I mean, we're buying
all major systems, upgrading
Yeah.
electrical. I mean, go down the list.
So that leads me to this. So what type of assets were you focused on in the beginning versus today?
So our original strategy, which is crazy, the oldest, worst assets we can find in the best locations. So we wanted an A+ location. We wanted to be in like core Santa Monica, core WeHo, core Silver Lake, but we didn't care if it was 1920s, 1960s. We hoped it was as run down as possible. And that was our business plan. And we spent a ton of time and ton of energy remodeling these buildings.
Yeah.
And what we realized, because we had 30, 40 projects going at a time. Like,
Oh
it was
my gosh.
kind of
I don't
crazy.
know how you do that.
And Jordan actually came in, and I'll give him full credit for this. He's like, what are we doing? Like, we could do the same thing with a newer vintage, cut 80% of what we're doing and get the same result.
Okay.
And it was almost like a aha, like, you're
Yeah.
right. Like, why aren't we buying 80s, 90s, 2000s? They have similar arbitrage, right?
Yeah.
Like, you
Yeah.
can still increase the rents.
Yeah.
You're not going after these major systems, which is what is so painful. And when you're doing these big rehabs. And so since about COVID, honestly, I don't think we've bought a building that was older than 1980.
We have not.
Yeah.
Well, but it makes sense too, because if you're buying City of LA, then you don't have rent control, correct?
We were
'Cause
looking,
isn't it
we were looking for AB
1978?
142. We wanted to
Yeah.
be universal rent control. Where we had the ability to increase rents by 5% plus CPI, and
Yeah.
that leads to our attrition tool, right? So we
Yeah.
no longer, as the environment's changed over the past 5, 6, 7 years, the idea of going out and doing a large scale cash for keys only brings things you don't want. Right, you have tenant uprisings, you have
Yep.
attorneys that
Especially
are
in
going to get
LA.
in there and create, big class action type lawsuits. And when you start poking a tenant for a buyout, it also brings up all the other issues that they may or
Yeah.
may not have been experiencing.
Yeah.
Yeah, we're in the middle of that.
Yep.
And so that
But
new
luckily,
vintage is
it's
just
been
like
going well.
just increase rents by 8.5%. And by the way, if you don't leave, all good. We didn't spend any money on your apartment.
Yeah.
And
Yeah.
after a 3-year period, we're up almost 30%.
Yeah. That's
Oh, okay. So how much turnover do you find just doing that? Like by just raising the rents like that? Are
That's
the
a good
people
question.
That's a
leaving?
great question.
So I think it's been pretty consistent. So over a 4-year period,
Okay.
right? If you do this, about 80, 90% of the tenants leave,
Yep.
roughly.
We've
Really?
outperformed
Okay.
our pro forma every single time. We always assume by year 3 or 4 we're 60% through, and we find that by year 1.5 we're 60%
Oh, I
through.
really love this. But question, how do you then do you just have all of the construction money that you need for these remodels? Like how do you
Great
Yeah.
question.
because you don't want to have a bridge loan for that and sitting there and paying all this interest. So and then you take on a lot of equity. You've got to be careful.
Two ways to capitalize it.
Okay.
You want to take it?
You got it.
We either capitalize it up front and we say, listen, we're never capitalizing 90% of the units up front. Like we just, so let's just say we assume a 60% attrition rate and we
Okay.
want to capitalize for those 60% of the units to be turned.
Okay.
We'll do that up front. It's really investor specific. We have one guy that's like, listen, I don't want to put it all up front. Cap call me every time. All good money cap call.
Oh.
Let's put the least amount of equity we need to close. I know where we're going to get, and let's
Okay.
just take it. But that's a different investor. I'd
Yeah.
say
Right.
that's more rare. On
Yeah.
the former is we raise the money up front. It sits there, and
and you just estimate what you think you're gonna need, and
Just sit
This
there.
is why
put
it's
it
called
in
a pro
CD.
forma, and it's not 100% accurate. But
Right.
yeah.
we have
Here's
enough
what's
experience.
interesting though. So when you do this, right?
Yeah.
Like let's say you bought a building 4 years ago and the rent was $2,000. Now it's $3,000 because you did the increases. I'm just throwing out numbers.
Yeah.
That apartment may not be worth $3,000 in its current condition.
yeah.
Like think
Right.
about it, right?
Mhm.
Because maybe it was actually should have been a $2,600 apartment, but the tenant stayed.
Yeah.
And so you get this apartment
Oh.
back, right? And it's $3,000, but you have to spend money just to maintain the rent.
Yeah.
So anyway, nothing's
Mm.
exactly
Nothing's is perfect.
Yeah.
as perfect as you think because the
Right.
business plan would be great if that was actually 4,000 and you could spend the money.
Right.
So there's some issues with the business plan, right? Because
Right.
you're kind of going backwards
Yeah.
to maintain. But it's interesting.
Yeah.
But that's how, because I was curious when I was like, how are you guys buying in the city of LA and doing this? And that makes sense because you're doing it that way where they're leaving on their own
Correct.
versus having to get
Yeah.
into.
We haven't done a programmatic buyout in 5+ years now.
Ooh, I might change
Give
my
or
whole
take.
underwriting now.
And
This
we'll
is
take
so
a buyout. If
exciting.
you come to us and you
Oh,
want
Yeah.
a
please
buyout,
do.
I'm happy to do that, but we are not knocking on doors.
I think one of the things as real estate investors is we like certainty, right?
Yes.
And there's so many things in real estate that are not certain.
Oh my
Oh,
god.
The
yeah.
market, the environment, the OpEx, insurance. We can
Wow.
go down the list. But if your value add business plan is not, there's not certainty around that. That's really hard.
Yeah.
Yeah.
Meaning, if you have a 100-unit building and you can't fix and add value to the majority of your units, it's not a good investment.
Yeah.
Right.
So anyway, that's been really our focus. And the same on the lending side. Like when someone comes to us
Yeah.
with a value add business plan, we want to have certainty around that business plan. So that's kind of how we get certainty. It gives us a lot of comfort around it. It's one of the reasons we actually invest in you guys because we have certainty that you guys are going to do your business plan. But there's a lot of analysis.
Oh,
that
yeah.
It's
goes
like when you're looking at a loan from us and you tell us how many units you're going to buy out, like we have to discount that, right? We
Yeah.
assume. I hope that's the case, but we also know the reality could be less, and so we hedge for that downside risk.
It's so funny because
Yeah.
we've been really lucky in that I feel like where it hasn't really been, that's not been our issues. And I think that's kind of shocking to a lot of people because it is a lot of uncertainty up front.
Mhm.
But yeah, I mean, pretty much
We just sent out 24 buyouts last week, and all 24
they're all
signed.
signed.
First of all,
Amazing.
that's amazing.
I'm meeting with 8 people on Saturday giving checks.
That's great.
I
out of
also
that.
think you're playing in a market, a sub-market that is not
Yes.
as, I don't want to say beaten down, but has
Yep.
not dealt with this level
Yeah.
of cash for keys in in LA where
They've
we're
never-
buying, like
nothing.
every tenant in every building has been approached by
Yeah.
somebody.
No, never.
Yeah.
Like Ventura, these buildings haven't even changed hands in 20,
40,
30
yeah.
years.
Yep.
So that's the thing too, is like, I feel like in this area in particular, like you're getting buildings where it was like the Depression era owner, right?
Yep.
Bare minimum put in. And so you have all this room because the units are really in bad condition.
Yep.
And then our rents out here, this is the least affordable metro
Mhm.
when you look at wages to actual pricing of housing in all of California.
It's a crazy stat.
I mean,
So yeah,
let's be
people
honest,
don't
guys.
realize that.
This is a win-win for everyone, right? It's
Yeah.
a win for the tenant because they get capital. They can go find a similar apartment so they're not displaced. It's a win for the community because you're providing better housing,
Yep.
right? And you're fixing buildings that wouldn't get fixed, and it
Yeah.
Oh,
brings
yeah.
more, economic development
Yep.
into the area. It's a huge win. Like sometimes, like there's a lot of faux pas around this, but like people are winning. Like this
Yeah.
is great. We are reinvesting in your
Yeah.
community, and it should be said more.
Well,
Yeah.
but
Yeah.
we're not forcing anybody to take the cash for keys. This is a negotiated agreement.
Yeah.
So like the stigma around it, to Mark's point, is off base, and I think it's off base because you have a political system that decided that's not the right way
Yeah.
to do it. But
Yeah.
they don't give you another
and the thing is
access
too,
point.
it's like what I try to explain to tenants, because I'm usually customer service whenever they're upset, and I'm the one who deals with them. And I'm like, here's the deal: like your previous owner, gave you a great opportunity of having very low rents for a long time, but they were not going to sell based on those rents.
Mhm.
They sell based on the potential. And so I'm sorry that I'm the one having this conversation with you, but it is what it is. And so you got that benefit for all those years, and hopefully you saved a lot of money.
Yep.
And realized what you
Yeah.
had,
Yep.
And now you have a check to walk away with. To
Yes.
go,
Yeah.
which I don't have to write you, but we are writing you, and we write into it. Like I have friends on city council here, and I've told them, I'm like, you might want to consider, like Oxnard has done, and having some sort of, and
Rent
it
stabilization.
still hasn't come up on any meeting.
Yeah.
Nope.
So I was like, whatever.
So switching gears a little bit, capital markets. Mark, what are lenders actually looking for in a sponsor today?
It's a great question. I think first and foremost, as I said, we're partners. So like we want transparency and honesty.
Yeah.
Like if there's issues, because there are sometimes issues, we just want to know about it up front.
Yeah.
Like I cannot
Oh.
tell you how much better the conversation goes when you actually know the file
Yeah.
immediately. And if there's an issue in the file or issues, so like that's always number one for us. But number two, we kind of just talked about it, is your execution capabilities.
Yeah.
Like you probably hear a lot that like lenders just want to know how much money you have and what's in
Yeah.
the bank and what your bank statements are. The real truth is we care about operators that can execute.
Yeah.
Yeah.
Because if you execute your business plan, you're going to go get a regular Chase note or agency
Yeah.
note with no issues. So
which is
it's-
what we want for you at the end of the day.
That's
we
right.
want you to be able to
Of
course.
refinance
Yeah.
this thing
So, like,
successfully.
being honest and transparent
Yeah.
is awesome. That's, I think, a given, but I have to say it because I can't tell you how many files Jordan and I get that I wish we were honest and transparent. And then secondly is the execution.
Yeah.
And like some just ways we think about it as a lender is like we like to see case studies and your track record and your
Yeah.
SREO. And like it's so much easier when you say, hey, and one of the reasons we love you guys so much is like it's really simple. You guys do something very specific.
Yep.
You guys buy in a certain region, you do the similar business plan, you have case studies that do it. Like that's a easy check
Yeah.
as me as a lender saying
Yeah.
these guys are going to be able to do it. No problem.
We don't want to see lenders that are jumping geographically all over the place, different asset classes,
Yeah.
unless you are already nailed it
Yeah.
and everything else, and now you're just getting opportunistic. For us, we want, similar to our business plan, like what's your thesis? Where's your submarket? Are you doing it over and over here again? And
Yeah.
that gives us a lot of
That
sales.
is
Yeah.
one thing, like we do get asked, like, oh, are you going to look at other areas? And I'm kind of like, why? Like, why do you need to go? We looked out of state before we even bought in California because everyone's like, oh, you can't make any money in California. And I was like, well, I've been doing real estate in California for almost 20 years. I'm like, I know the laws here. I understand the tenants. Like, I get that. But I was like, I looked at cap rates we were looking in Utah, Idaho, Texas, Arizona,
Florida.
Nevada. And you're like, these cap rates are not even better than what I can get here, and I can build ADUs.
100%.
So it was like, why would you go and buy out of state where I can't even drive to it?
I think the biggest issue is if you can't go visit your site.
Yes.
Especially as a lender, if you're saying I'm doing a massive value add project in Arizona and I'm based out of California,
so much.
You better convince us that you have a real operations on the ground. And you guys feel this, like if you don't go to your property and you don't go to the construction site and you don't see what's happening, like delays, overruns, and go down the list.
So here's some like headlines, just because we see it on the lending side. The majority of flow we see right now, especially out of state in like the Sun Belt, and you can add Texas and a few other states to that, are operators that bought in the last 4 to 5 years.
Okay.
They're out-of-state operators. They use third-party property management, and they got utterly destroyed.
Yep.
And so we're seeing those deals now at reset bases with actually sponsors that have the exact opposite. They usually have in-house property management. They usually have an in-house state team. They have thousands of units. So it's what you want to see. And they're buying great deals at these reset bases that shouldn't probably never existed 4 or 5 years ago, but now they exist.
Yeah. Every building that I have underwrote, I have seen fraud from every single property management. And I'm like, that's why I was like, no, we are starting our own property management company. We are managing them ourselves. Like, yes, we don't ever get to go on vacation or do anything and have a day off. But in the same respect, like when you're asking your family and friends for money, like I want to be able, that makes me sleep at night, even though I have to deal with those struggles.
If I think about our past, one thing we waited too long to do was take property management S. Like that was, if I look at, again, there was a lot of wind in everybody's sails for years, right?
Yeah.
And so like, it was hard to mess up. Even your worst property management, like units were still leasing above market and moving quickly and all the things. But in the last 4 years, as the doom and gloom is real, we took a hard look at asset management and said like, as micro managing that we do to our third party, like you just don't have the right visibility.
No.
Yeah, I agree.
So what are the biggest mistake operators make when approaching lenders right now?
That's a great question. I think the number one thing is missing their pro forma, right? And their actual business plan, right? So like, I'll give a great example because it happened yesterday.
Okay.
We had a deal. It's a retail deal in LA, and it's like we're seeing a lot of this, by the way, which is really cool. Like value add retail. So like those strip centers you see everywhere in California, they're like kind of like apartments. They've been mom and pop down for decades.
Yeah.
The same vape store's been in there for 100 years, and there's opportunity to put real, new, Gen Z, millennial, whatever brands in there and increase the rents. And I kind of know the rents in retail pretty well. And someone said it was going to be like $8 a foot, which is like kind of asinine. Like we're talking like Abbott Kinney type, like
I was like,
pricing,
wow,
right?
It's that high.
And not that
I'm
this
like,
area
I don't know
isn't,
retail,
but like,
it
when we see a business plan like this, we're already working backwards, right?
Yeah.
And so we don't want to work backwards as a lender. We really want to get your proceeds, but like it's almost like everything in the file all of a sudden gets questioned, right? Wait, hold on. If they're saying this, is the expense load right? Is this right? It just brings this level of question.
I think it questions their expertise, right? If this is how you're looking at the pro forma, like my gut says you're over or underestimating everything else.
What is it now? If it's 8, you said 8, what is it?
I think it's 3 to 4.
Wow.
Right?
Oh, wow.
So like it was a big difference, but here's the real kicker, and this is what we're really seeing. So the appraisal market right now is really hard. Right? So appraisals for a long time were pretty generous, in my opinion. The appraisers now are so tough. I would say they underwrite even tougher than we do. And so here's like, and it's just not us at Sunday, but you can go to any of the banks. When it's happening, you have no really leg to stand on to fight that either. So like it all trickles down. The truth comes out now, because there's no leeway anywhere. And so if I had a recommendation, it's be realistic on your business plan, ask for realistic leverage, and have backup on your numbers. It helps everyone.
Well, we had that problem in Santa Paula because Santa Paula is such a little tiny, like nobody even knows where Santa Paula is. And we had that issue with appraisers when they were going to appraise because they're like, how are you getting these rents? And I'm like, well, because we took a market that literally no one had nice units and we made nice units. And you know what? Low income people like nice units too. And we proved it. And so I had to show the only comps I would have is my own buildings. Because I'm the only one doing it. And so, but I will say when I underwrote in the beginning, I think it was Mark Schillinger who actually called me out on it. And he was like, you are not going to get 8% rental growth, Marissa, like every year. I was like, but why? I did in Santa Paula. And he's like, yeah, that happened. You're right. You did get it. but that's not realistic nationwide. I was like, oh,
Here's
okay.
here's
And it
a
was
We're
fun to
also,
know.
but that was 4 years
Yeah.
ago, we could do that.
Yeah.
Right?
Yeah.
We could assume
Oh,
all
I
these
see.
things, and we've been beaten down. Like, you almost can assume zero
Here's
growth
a
in
great
any of
piece
these
of
business
advice
plans.
for your listeners.
Thank you.
We do this always, and we haven't done it in the past, but we always do it now. We go to our appraiser. We go to our appraisals, right? So when you have an appraisal on your property, because it happens on every
Yeah.
deal you do,
Yeah.
guess who shows up? We all show up.
Yeah.
Right? And I cannot tell you how much of a difference that makes. I can't tell you how many times I call my appraisers on Sunday. It just happened actually today. They had the wrong rent roll in the appraisal. They said that
Yeah.
all the one bedrooms were, or all
Oh
the
my
2 bedrooms were
gosh.
actually 1 bedrooms, and the studios were this.
Wow.
And we noticed because the value was so off.
Yeah.
But like, all these things are avoided. And if you do it correct up front, it's so much easier to do it. But at the end of the day, you control your own destiny.
Yeah.
So like, if you're buying real estate, go to your things, go to your inspections.
If you are not
That's
at your
so funny.
number one way to hurt your appraisal is not being at your appraisal.
Yeah.
That is
That's
so
great
funny
advice.
because like in residential, you always,
Of
as
course.
the listing agent, you are always at that appraisal.
That's right.
Or if you can't be there, it is like, I'm sending you comps. I want to make sure, do you know what the purchase price is? Because that's the number one thing they usually have wrong. And they're like, oh no, I had it was this. I'm like,
Yep.
no, that's the loan amount.
Right.
Okay, purchase price is this. And so it's like, but you try 100% to just be there.
No,
in
we've
person.
literally seen it. Nobody showed up to that appraisal. We got her on the appraisal. Somebody
Yeah.
showed up to the appraisal. We got the
Yes.
appraisal we needed.
Yeah.
It was,
Yeah.
And
it
it's
was
not
binary.
because they have the wrong information.
Yes.
It's
Right.
not because they appraised it right. It's because they legitimately were working off wrong information.
Yeah.
You also
Yeah.
need an advocate. Like, if you're not there to advocate your property when it looks like the
Right.
same thing 50
Yeah.
times down the block, it's
Yeah.
really hard for somebody to look up, abstractly at this and say like, oh, I
Yeah.
get how you could maybe do better than the neighbor next door.
Oh, yeah. Yeah.
So
well, we had that on the Corvest appraisal.
So,
for
Mark,
Edgewood.
you and I have talked about this before, and I really think our listeners will get value from this. So, when Marissa and I do a deal, we usually bring on, 1 or 2 general partners to help with the funding or the raise, and then we raise from our networks. So, we can have upwards of 30, 40 investors, but we maintain like full operational control, meaning, we make decisions, we do the business plan. Now, and then that's like usually a 70-30 split. So I've talked to you on your, like now when you're buying deals, it's like 1 investor, 2 investors. So do you still have the control like her and I do? And do you still have like the similar splits?
So it's a great question. One of the things that we noticed over the last 5 to 10 years is when you're dealing with a large set of investors, it's a lot of time.
Yes.
And we want to give everyone that attention, right? But when you're trying to scale, when you have 30, 40, 50 investors in any given deal, it's a lot of just work and extra things. So as we've been able to grow in our careers, I think we're proud of this. Jordan and I have been able to take that list from 30 to 40 to maybe 1 or 2.
Yeah.
And it saves us a lot of time, a lot of energy. It's more of almost a JV partnership with our family
Yeah.
offices, which we really appreciate.
Yeah.
But in turn, those 1 or 2 investors get a lot more controls.
That's what,
Yeah.
And those controls tend to be what we call major decisions.
Okay.
And so it's not that we don't control the day-to-day operations.
Yeah.
Our partners want us to, because that's what we do for a
Right.
living, right?
Right.
Or not that we're not going to do the construction or leasing. That's
Yeah.
what we do, and that's what we're good at. But
Yeah.
what we don't control is major liquidity events and major decisions that
So
have to do with the building.
refinancing, selling the building, major capex.
Yeah.
So they're involved in all of that.
absolutely.
Well, because if you're only having 1 investor, they own more than 20%, so they're on the loans with you.
No. So
How do you get around that then with the lenders?
So again, we're the manager. So the way that lenders usually look at it is who has the day-to-day controls of the management of the property. That's what
Okay.
we care about at Sunday, and that's what most lenders care about. It's not that we don't own more than 20% of the deal. Again, we can't sell or refi or do some of these major things without our major investor, but the lender doesn't care about that because they know that investor exists.
But out of fairness, our
Oh.
balance sheet's grown, right? So
Yeah.
like over the years, and that's a value to our main LP is that we
Yeah.
aren't asking you to be on the debt. Is there some kind of a guarantee on a large deal that he might sign on? Yes, but
Okay.
not making them sign on the debt was a huge part of a proper relationship and reducing risk for them.
What about percentage? Is it still 70-30 or?
Every deal's different, quite
Okay.
honestly. And one thing that we're trying to do, my word of the year is leveling up. Jordan and I are trying to level up.
Yeah.
Which means getting out of the weeds and doing more.
Yeah.
While not being in the weeds. That's hard. We're working through it.
We're not there.
But one of the themes of leveling up is that we're trying to do bigger deals. Because you know what we've learned in our career?
It's easier.
Not easier, but doing a 10 unit is like doing a 100 unit.
Oh,
just like 100 units, like doing a 200
Same
unit.
amount
But the difference is a one vacancy in a 10-unit building for 2 months can completely destroy the business plan versus a 100-unit building. There's just a little less pressure and you can make a little bit more mistakes.
But back to your question, as we try to level up, right? We're gonna lose some of the things that we're able to do on our smaller deals.
Yeah.
We'll probably have less controls. They'll probably have even more major decisions. There's more belts and suspenders that come with more institutional capital.
Yeah.
You get more capital and you can do bigger deals, right?
Yeah.
So that's all good. But some of the control that we have currently is going to go away, which we're okay with because, again, in order to level up, you actually have to play that institutional game.
Yeah.
But to answer your question on the splits, we've moved away on sub $20 million deals of having any pref. So we believe that if you have a hurdle there that's not achievable, and this isn't us, but a sponsor very well might say, like, I just don't have the motivation to keep pushing this thing forward. I'm never making money on it. I don't share in it until after 8%. And our idea, our method was like, why don't we just share in all of it? We'll take a small piece until your money's returned, and then we'll take a bigger piece.
Got it.
But I'll never forget our main family always said, like, that's a much better alignment for us.
Yeah.
Like, I want you to make money because I want you to be motivated.
Yeah.
And I want you to continue to push the
I went away from it after our first deal.
Here's a word I
was
call
like,
it.
no more.
We
No
call
one
it a
gets
zombie operator. You know what a zombie operator is?
No.
So a zombie operator is someone who's in a deal and has maybe a pref structure, maybe has these high hurdles. Maybe they're in the deal for 6-7 years. If you have a 12% hurdle that's compounding every year, that means in order for you to make money, you have to more than double everything, right?
Yeah.
Just to even hit the promote. And so all of a sudden you have a structure where the GP is never going to make money, right? Because of whatever the factors are. We'll call it hurdles or pref or whatever. And they're zombie because what's their incentive to do better?
Well, they need to go find the next deal because they need to get the syndication fees.
And there's some large syndicators that you've seen go down in the past couple of years that was 100% why they failed. They said, we're never hitting this ever. We have too many properties, too many things to work on. Like, just don't pay attention.
That's a misalignment.
Well, and that's where, like, our mentor, when we first started, he only bought out of state. So he was able to give these pref returns. So we did pref on our very first tiny little baby 6-unit, 1.2 million that we bought, right? But then I said to Danny, I was like, we can't do a pref.
Yeah.
I'm like, this is not about cash flow. We're buying in California. We're doing a huge value add play. This is about an equity gain.
Yeah.
So you either are going to get most of that when we sell. So like, I can't give you even 2-3% because the first 2 years I'm giving you 0.
Yep.
And so I was like, look, you're either in or you're not.
Yeah.
You know, this
and there's
is
plenty of people that want.
We have no issues.
It's actually one of the reasons.
No, we've had no pushback.
On our debt business, we don't do pref or mezz, and we don't allow for pref or mezz on our debt business. And the main reason is because our borrower ends up being not you guys or someone like us. It ends up being the pref or mezz. Like, that's not why we're doing the loan.
Yeah.
But if you really think about it, who's actually in the fulcrum position, it's not your equity holder.
No, they're in the first position above them.
So that's tough.
Yeah. No, that's
when we see a loan with a
answer.
big pref piece, it's like it's an immediately, we discount that
Well,
deal.
when I read people's like syndications and I see that, I'm like, how are you giving that? Like, I mean,
and how's anybody making money? I'm even concerned.
Right?
How does the pref ever make
well,
money?
and especially out of state, because I'm like, okay, so you have the cash flow, but you don't have the equity portion, right? So then I'm like, but how are you sustaining this? Like,
Yeah.
But
over term?
that operator's not going to make money on that deal.
Pref pieces work well
there might be some
in
fees.
very small time frames, right?
Okay.
So for example, you have a really distressed deal that you have to buy, you have to come up with equity, but you can take the pref piece out because you're adding the value so quickly.
Okay.
That makes sense to me,
Yeah,
right?
yeah.
Like, to maintain operations or pay your taxes or insurance, that's a path you're going down that I don't think makes sense.
Yeah.
Yeah, I agree.
So shifting gears a little bit. So Jordan, I want to shift to the execution side of business because the side I live in every single day as an operator. So how hands-on are you during construction and repositioning the projects?
I mean, we are as hands-on as any owner could possibly get,
Yeah.
from the handles on the cabinets to floor colors
Yeah.
to paint colors to, I will go visit to see the swatches that are put up on the walls. It's very easy for a contractor to start doing their own thing and get to a point in the renovation to where there's no going back.
Yeah.
And we
seen
learned
that.
our lesson, a few too many times probably, of we weren't there for literally 4 days. Every single the flooring's been laid in every apartment. Every one of it's wrong.
Oh,
I'll never forget. I got, I can tell you where that was today. And it's like, oh my God, we're talking $150,000
Yeah.
mistake that could have easily been
Yeah.
avoided if we were just there.
Yep.
The hardest part of what we do as operators is controlling our contractors. We certainly tried.
That's why you're so stressed all the time,
Oh
huh?
It's
my God.
stressful.
And we tried to
So
take construction
stressful.
in-house. And I also realized that's also a really challenging thing. It definitely doesn't give you a layer of buffer between, when
Yeah.
things go wrong. It's a little
you-
easier to say we're firing this contractor and we're
Yeah.
hiring somebody new, or we're trying to pull money back from them, or whatever
Yeah.
that looks like, as opposed to ourselves. But we are, from interior, exterior, floor plans, every single detail
All in.
is outlined by us.
Yeah.
We provide a beautiful package to the contractor. I'm not asking for any of their opinion. To the windows, to the doors, to the 8mm flooring, go down the list. Because the minute you bring them in, they're not thinking the way we are.
No.
Yep.
And they're either too cheap where we want to not be that cheap, or they're too expensive where we want to be cheaper. And so it is, I'll never forget when in 2020, we had 16 projects going at one time. I think I put like 17,000 miles in the car that year. I mean, it was just like every single day, every
Yeah.
single
Wow.
site. And
That's
if you're
what I
not
was
there,
curious.
you know who doesn't show up that day to work?
The contractor.
Contractor.
Yeah, that's
Yeah.
why I was curious, because you had so many going on. I'm like, there's no way. But if you got 17,000 miles, yeah, you're doing
No,
it.
we spent all of our waking time. We took every conference call from the car. There wasn't a day where we weren't visiting. I'd say
Yeah.
there wasn't a week where we didn't touch every
There was a
site.
few
Yeah.
years we were not in the office,
Wow.
like legitimately.
Yeah,
we
I'm
were
not in the
just at
office.
every site,
Yeah, he's
at
never.
every time, at every. Here's something we've learned, right?
Yeah,
and
please share.
And sometimes TV is so great. Like, you see all these improvement shows, right?
Mhm.
And so everyone thinks, oh, we're gonna take this asset or this unit or this house or whatever.
Yep.
We're gonna throw some paint on it. It's gonna be like HGTV.
Yeah.
And it's gonna be awesome.
Oh my gosh.
And sometimes Jordan and I think in our past, we thought the same thing. Here's what's the truth. When it looks that bad, the bones are even worse.
Mhm.
And so I urge your listeners, when they think they can just add all this value, and this is where we've gotten caught in the past. No, if you open up that sink and you see those pipes, they're all rusted. They
Yep.
need to be
Yep.
replaced. So, like, a lot of the work we actually do in apartments doesn't add value to the bottom
Right.
line. You don't get paid for it, right?
Nope.
I think we
But
were
you
having this
have to do it to maintain the
conversation
asset.
the other
Yeah.
day.
Yeah.
We
Yep.
were talking about, I think, one of your properties, maybe it was the windows or something.
Yeah. Yep.
And I was telling you,
Yeah.
you're not going to get paid an extra $200
She
because
wants
the windows
windows.
are new or not.
Yeah.
You're going to get paid because the kitchen's brand new
Yeah.
and
Yeah.
because the bathroom looks brand new.
Well, you told
Yeah.
us to put in laundry that day.
Yes.
Yep.
And we're putting in laundry.
That's amazing.
If
Like,
the
Because-
single biggest thing you can do for your properties is put laundry in.
That's what we're doing.
Hands down. I'd rather
and you know what?
I'd rather you
It's
save
so much
money on
better.
$6,000 of other things
Yeah.
and put your
But for
wash
your
dryer.
listeners, it's
Yeah.
important before you get into your projects to do these inspections,
Yeah.
to do these property reports, to understand that you're just not putting paint on this thing.
Yeah.
Yep.
That you actually have to maybe change the bones of the property. And that's a
100%.
whole different level of renovation to then just saying, hey, I can replace the flooring, replace the cabinets, and put appliances in.
Yeah.
Well, it's the same conversation you have in residential when you go to list someone's house, right? Like, so they'll tell me all the things they have done, and I'll say, well, that's great. But all of these items that you did, people expect to already have been done. Your roof, your HVAC, like they're not expecting to go in and have old, right? But then you like paint and you do all these things. And like, if you do it well and you don't put in, like I had a cherry wood red cabinet kitchen with green granite. And I was like, I understand you paid like $150,000 for this kitchen, but this kitchen, nobody wants but you.
Well, you liked it, right? It was
Like,
valuable to you.
You enjoyed it.
Yes.
Yeah.
So the next buyer is going to rip this out. So it's like, that's the thing too, that you have to then like realize, like I designed our design. It is the exact same design. Anyone can walk in and make it their own. I do not change up colors. I do not go with trending things. Everything is timeless because I want in 20 years to be able to be using that same white shaker cabinet kitchen with white quartz, like with black hardware. Okay, maybe you could change out your hardware to stainless steel or brushed nickel if that goes back in. But yeah, like I try to keep it, and I'm like, no, I don't want to change.
And I would actually say you learned that quicker than we did.
Yeah.
Because I work in residential first.
I mean, if you took our first 40 buildings out here, every single bathroom's different. By the way,
gosh.
We loved it, but we mean, full tile bathrooms, beautiful green cabinets in bronze, hardware.
Yeah.
And at the time, it was great.
We thought black hardware was like the best thing since sliced bread. Like, man, those black handles and black knobs everywhere.
But you know what I learned? If you don't have to tile the shower, just get a beautiful shower slip.
Well, we learned that from you.
I told you about that.
I do the insert.
It even looks like you have subway tile in there somehow. And the renter doesn't care at all.
No.
I switched midway through herbs.
Yep.
I went to the inserts, and then now Warwick, you guys funded. All are getting inserts. In-unit laundry wasn't going in at herbs. I had to backtrack and install.
Yeah.
Whatever. Warwick, we're going right. We're putting it in, and then the one other thing we're doing, carports underneath, tuck under parking. We're converting to garages
because that's like a huge upsell because most apartment buildings out here have just they don't even have covered carports. It's just like a
people like this.
Well, now you're creating a storage unit for them too.
Yeah,
so like
you can have your Christmas shit.
Absolutely be able to charge.
Like if you look at
ROIs
on like value add apartments, like there's a few line items that by far out exceed anything else, and they would be in-unit laundry, brand new kitchens, HVAC, like actual like central HVAC AC, and then I would say bathrooms. Those
you can't avoid flooring.
You
should not have carpet in your apartment.
No, we do all luxury vinyl throughout.
We do all luxury vinyl.
Like, even if you do nothing but throw vinyl in,
100%.
you make it's a huge difference.
And it's cheap now, and it's nice and great, and
it's so much better.
It's the difference between somebody saying this is an old property versus a new property.
100%.
So what's the biggest mistake sponsors are making when they're underwriting renovation budgets?
I'll give you 3.
Perfect.
Underestimating their construction budget.
Yep.
Hands down. We've all done it. We all still do it. You are always going to be 20% off.
Yep.
I think.
20%. Okay.
I think.
That'd be good.
Not understanding how valuable time is.
And
if you miss that month,
my fucking
like that 1 month is literally in a 10-unit building could be the difference of making your year or not.
Yeah.
Oh my gosh.
And not leaving 100%. A contingency in the budget.
The contingency?
Contingency is real.
How much do you?
10 to 15%.
So wait a second. So you're assuming let's just say simple numbers. Your budget's $1 million. You're saying you should do 1.2 plus have a contingency on top of that?
Yeah, maybe you bring it down to a 10% contingency, but I promise you, that'll all be, you'll use your full budget and you'll have dipped into your contingency.
I agree because I underwrote Warwick thinking I was like being so conservative and generous at $65 a unit. And then he's like going, and I'm like, wait a second. I'm like, so you didn't spend $50,000 a unit at herbs and you did spend close to this. And now I'm not as like conservative and have all this money as I thought. Like we're fine because
that extra 1,000, 2,000, 3,000, all of a sudden you multiply that by 10.
Yep.
Yeah.
And I'll give you one example. In our inspections, we can only know so much.
100%.
Right? And to Mark's earlier point, you buy these really old properties. The minute you own it and you start breaking walls down, you're like, oh my God, I had no idea this. I'll never forget. We had a structural beam that we didn't know existed. And we started doing the construction, opening up the walls, and we're like, oh my God, it's fully rotted. And we had to replace, that was $30,000 fix. That there's your contingency.
Yeah.
Right?
Yeah.
Here's the other thing that's surprising, and you'll appreciate this from your single family home time. When you start touching things, other things start looking really bad.
Yeah.
So like if you think you can just change the paint, all of a sudden you have brand new paint, but everything else was from the 60s.
Yep.
It doesn't make sense.
That's your window conversation.
Yeah.
I'd rather see the same frame on every unit that maybe you guys scraped and repainted, but it's a 1980s frame versus when I walk around, I see new apartment, old apartment, new apartment, old apartment. What that says to a renter is, oh, there's a lot of like old apartments here still. Like this is clearly a lipstick on the pig job and they undervalue, the rent.
100%. Yeah. And the other thing that I've learned is that, and why we actually, so like on Warwick, the one you guys did, it's like 12 units. It's 36 units. We were going to do it all in 3 sections. I realized with the construction budget, I would end up having my last 12 units ready to rent in November. And I was like, no.
Can't do it.
Because I just had that happen on herbs. And now here I am
and
in
you went
February.
3 or 4 months vacant because you couldn't
100%. And I said to the contractor, I said, can you get 24 units done Like, how long will it take you? And he said, okay, it's going to take me 8 weeks instead. I'm going to have to bring on other crews. And I was like, okay, but can you do it? And then I'll be done with 24 units in July.
So the money
So
you're
much
paying
better.
to increase it actually will outweigh.
And I don't
the
have to
vacancy
actually pay
loss that you're
more.
gonna get.
He's making less because he's like, well, if I'm going to make less, like I'm going to make it faster.
Let me get out of here quicker and move on to the
Yes.
next job.
That's great.
But I was like, when I started to look at that, because I was trying to time it out, and I was like, oh, no. I don't want to be, hey, here's brand new units in November and December. Nobody wants to move.
Here's the other thing we've learned. Jordan will love this. But in California specifically, but most markets, I think also, you can't just do the units. So if you had like a pimped out 60, 80K reno done unit, best in class, and the building looks like it's stuck in the 60s, guess what? You're not getting top rent. And as much as we've said it sometimes, we've done this in some of the properties where our units are just...
We did it half the time.
Yeah.
Where the business plan was,
nope,
go hit
curb
the units
appeal
hard.
matters.
No, now it's go hit everything. But like we need exterior hallways, courtyard, landscaping done immediately.
Yes,
and we'll work through the apartments at the same time. But I can now start leasing units while other units are under construction because somebody walks in and says, this isn't a construction site.
That makes me feel good because I spent on herbs a lot of extra money on the front exterior. I did this limestone rock, and then I did these storefront glass doors and redid all the landscape because it was the old 60s rock Playboy mansion, disgusting. And
and it was like a wrought iron security gate you walk through. I was like, no, I'm sorry, you're not going to get the rents, even though like you have to change these.
Well, people look at the building as their home, right? They have an apartment in the building, but like they want to be proud to say to come over to my building and it doesn't look like it's a rundown,
100%
hostel.
So I'll be honest, as a hands-on operator executing heavy renovation value add deals and bridge debt timelines, execution pressure is real. And how would a sponsor be thinking about bridge debt in today's environment? But more like, how do you deal with that like stress and that timeline and that environment? Because I know this Mark Silver is going to be calling me and saying, "Hey, Edgewood, we're getting close."
Oh no, I actually have to send an email. We can talk about that.
Should we do it right here, right now?
I'm like, I actually need to get my extension
No
6
problem.
months.
All
I
good.
already
Here's the number one thing, and we do it too, so we can be in the category of blame. Everyone thinks they can do it quicker. Everyone. And so here's what we really like to say. A real value add business plan takes every bit of 24 months.
Yeah.
It just does.
100%.
And I can't tell you how many sponsors come to us and are negotiating like things in our loan docs that say, hey, we want a minimum interest period of 6 months. We're going to be done in 4 months. I'm like, there's just no way. But these are the things that you really need to think of because this is where you get hurt. And this is where you really need to think of what you're spending because time, I think Jordan made this great point earlier, time kills you. And so one thing we try to do at Sunday is we really want to match the business plan with the time of the loan. Like the last thing we want is you're not done and the loan's due and you have to get another bridge. Like that's terrible. Like that's the last thing we want. So we want to work with our sponsors, but it's a huge mistake we see. It usually takes a lot more time and energy. And we can't forget, just because you have the construction done doesn't mean you're done. You're like halfway there.
You still have to go
like getting
through
it leased up
You
and
still have to
all
lease
the
the
things.
apartments.
Yeah, the
That
lease
could
up
take 6 months in
apartments.
itself.
Yeah.
In an
100%.
environment where things just aren't flying off the shelf.
Oh yeah, 100%.
And you have competition now in markets to where everybody else is doing value add. When we first started, we were the only guys in the block. It was very easy. Now the block has 15 other apartment buildings that got renovated.
Yeah, we luckily don't have that as much here. We just have we just had our first building in the area sold to Blackstone.
Nice.
Well, there you go. The institutions are here.
They just bought it. It was actually a relative of his who developed it. Was an old RV lot.
Amazing.
And developed it to a mixed use project, 110 units, and sold for $18.5 million.
So thesis proven. Doesn't
Yeah,
that feel good?
that's the first one.
That feels good.
I sent that article to every investor.
Yeah, like, guys, we were right on our vision here.
Yeah. And I'm not tooting my horn that like when I'm dealing with the city of TO right now and adding these ADUs, we're the first one to come in and do large multifamily ADU ads. So they're like, no, you can't do that. And we're like, yes, we can. And battling, and we're getting the yes, but we're on the forefront of that.
But
Well,
we're
you
the
guys
first.
are doing the dirty work for all the other guys.
Oh,
coming after you.
100%. We're the first in Oxnard.
Yeah, you
Would
guys
you
are the-
ever think in Oxnard, with how many apartment buildings there are, we would be the first ones adding ADUs?
It's crazy to me.
Literally. I mean, Santa Paula, I knew. Okay,
I want to say
nobody's.
yes, but
Did-
just because
really?
I know the ownership base.
No, I just think you're talking.
Yeah.
You either have new development or mom
Yeah.
and pop
Oh,
ownership.
yeah,
Mom and
that's
pop
true.
ownership's not doing.
Yeah, they're like, we
But
don't
I
need
was-
that
They're like,
shit.
there's
Like,
Well,
no,
it's
we don't
such a
need
headache.
Yeah, we don't need
It
to.
is. Yeah, because
Parking,
you have
all
all the
this.
like old school owners who've owned forever.
But
This
then we see
stuff's-
the operators that think ADUs are the answer to everything, and we see that business plan a lot, where it's like, all right, you have a 20-unit building, you're building 10 ADUs, but now you've removed all the parking.
Yeah,
So we say to
Yes.
ourselves, well, that's a $400 discount, or maybe unleasable
yeah,
to the existing units.
We
Listen,
made
we-
that mistake on
we
one
had
first.
this conversation on one of your deals.
yeah,
Yeah.
You were doing more ADUs, and I commend you. You guys realized you were taking too much parking away.
Yeah.
And you fixed it.
yeah,
And I think I called you and said, genius.
yeah,
I would have
Yeah.
told you to do that, and you did it.
Yeah.
So, yeah.
yeah. And
Yeah,
that
parking's a
lesson
big
learned
benefit.
on parking, like it's such a, like you said, it reduces, people that are coming in, like you need a fucking park spot.
It's
know?
also like binary: no parking, not renting. Like it's not
Mm.
even like I didn't like the cabinet colors. It's like I don't feel comfortable parking on the street.
yeah,
And it's so we would never buy a building that didn't have parking.
Yeah.
Here's a business plan we see
Mm-hmm.
all the time. And it's based off that LA mayor's directive, ED1.
Oh, one of our friends out here, city councilman, he's actually the mayor right now.
Yeah.
That's all he's doing. And I'm like,
And just for your
Mhm.
listeners, ED1 was the executive director by the city of LA, Mayor Bass, on being able to basically take any
Yeah.
asset and turn it into affordable housing with no parking requirements.
yeah,
And so what happened was, that sounds great, right? So we'll get it zoned and permitted quickly. You can basically do whatever you want,
mhm.
but you're left with assets that only work in a very specific environment, which has subsidized housing by the federal government.
yeah,
And so when we look at, like, on just putting my lending cap on, and Jordan, I think, would agree with me, if it only works for one business plan, we don't like the real estate, right?
Yeah,
Like we
100%.
want it to work in any environment. So like if you're doing affordable housing, which we love and we're super pro, we also want it to work for market rate. And you know what doesn't work for market rate? Small apartments with no parking.
You also have a lot of developers that are just not experienced enough to be doing affordable housing, and there's nuances in permitting and
Yeah.
like it is a really hard space to navigate. Like I don't think
I'm
we
thinking-
would be great at it, and we've done 100
I'm
buildings.
thinking
out here.
about Jordan and I a couple months ago went with someone on a tour of one of these ED1 projects.
yeah,
And I swear, I don't think the apartment was bigger than the studio. Like legitimate. It was probably narrower, actually. And the guy looks at us, and I'm looking at Jordan, and I'm like, what do you think he's getting on this rent?
Well, no, hold on. You have to back
Yeah,
up. He
yeah.
was calling them one bedrooms
Yeah.
when they were absolutely legal studios, and I
Yeah.
kept saying, I hear you that you're pricing these as one beds, but literally there's no legal possibility that these are not anything but a studio. And halfway through the lease up process, he realized like, no, Hackler, whoever it was, is not deeming those one bedrooms. They are actually studios. Brought his pro forma down by 30, 40%.
I was trying to get like $2,400 for
Wow.
like 200 square feet.
Oh my gosh.
Wild. And that's, again, back to the ED1 thing. But like, these are the things Jordan has a great line. It's upstream activities in a downstream market. What do you say?
Yeah, I say things like furnished housing or co-living. Those are all Band-Aids in a down market.
yeah,
Right. And when the market pops back up,
Yeah.
you won't want that Band-Aid there because maybe that Band-Aid went out of business and now you're sitting with 70% vacant. Like go down the list of issues that filling your buildings with
Wow.
a stopgap or something where you're arbitraging the rents by so much, it's not realistic.
I'm
Yeah.
glad we're not doing that.
yeah. I mean, geez, we could keep going, but there's a couple things I want to hit real quick. What separates operators who deliver the business plan from those that get overwhelmed?
There's a couple of things, and we've said this a few times. Honesty and transparency.
hmm
Okay.
Like honest with yourself, A,
Yeah.
right? Honest with your investors, B. And I think when you stop being honest with yourself and them, things go down a bad path.
Yeah.
Timing is really important, and distilling a big problem into smaller compartments, right? We have a
Oh.
big problem at a building. I'll give you an example. We have a building where we went from IO to P&I, rents went down, we're not covering debt service. The cash in refi is $1.5 million that equity's not doing. that's a big problem.
Yeah.
And that's overwhelming to ourselves. And we're saying, oh my God, how are we going to fix this? Well, let's break this all down. What are the steps that we need to do to even get to a point where we're talking to an investor about a cap call?
Okay.
Well, let's go get a BOV from the market.
Yep.
Maybe we actually put the building on the market, because the first question from that investor is, well, let's sell it. What would we get? Well, we've already gone 4 months down that path, because we are way early on the end of that timeline. And so by the time I'm talking to an investor, rates might have changed, the cash in went down a little bit, and I've already done steps A through D.
Yeah.
And they're saying, okay, like, you did a lot of upfront work. You did everything I would have already asked you to go do, and we did that preemptively. So it's like, how do I take this big problem, chop it up into a bunch of pieces, start getting through those pieces, and then start being really vocal with your investors? Like, here's exactly what's happening. Here's exactly what we've done. Here's all the numbers. Here's how we're going to fix the problem. And here's what the outcome's going to look like for you. And by the way, you might not get the cap call, or you might not be able to solve the problem. And maybe it's selling at a loss, but going to bed at night knowing that, like, as the fiduciary of your money, I did everything I could possibly do to try to right the ship.
That's great
I
advice.
agree with that 100%.
That's really good advice.
I'm all about I'd rather just be super direct with people, and because I've always found that when I'm negotiating any sort of real estate, like, if I just come with you calmly and give you all the steps and the information and say, here's your options, then they're usually like, oh, okay, great. Rather than I meet these, residential, I mean, it's like, it's really rough. And
you have emotions involved.
Oh my gosh. Even the agents are just like, I'm like, just freaking tell them this is the issue. This or this. What do you want to do?
So
make a decision.
Yin and yang is, I'm bad at ripping the Band-Aid. Mark's too good at it.
I
so
love
like, there's
ripping
got to be.
yeah.
Sometimes Mark's like,
That's
I'm going to
me.
do it right now. I'm like, no. There's like a cadence to this. Let's
That's
wait.
me.
But
I'm like, let's just tell them. I'm like, this is what we need.
But fine. Like, I assume you're not as upfront as she is. Just judging by the personality, maybe she's more direct at things. Like, I like to massage it. I'm a big relationship guy. I'm saying to myself, let me call them first. Let me, and there's a middle ground to all this. Right.
Yep. You guys.
But what we've learned is transparency.
Yeah.
And what operators do wrong is they hide it all until the end, and then shit hits the fan.
I
and
would
then you're in a bad
also,
place.
if I had to say one thing to operators right now, and I think you're maybe hearing it in what we're talking about in this market, do less.
Yeah.
Less is okay, right?
Yeah.
Like, this isn't your house.
But that
right?
arbitrage isn't there the same way. There was days where we were taking $1,000 rent and making it $4,500. Like, our thesis is the value add game is very different. And unless you're looking at certain submarkets that have never been touched, that are between legacy and new rents is much smaller than you think. Or you think it's going to get this, but I promise you it's 30% less. And if you spend the 30% more to get it and you don't get it, you're screwed.
Yeah.
But I do think, like, when you were saying to add the laundry, like, we heard that right away. Like, on the Herbs one, we started renting it, and they're like, oh, you don't. And we were like, oh, this is not like Port Hueneme, Oxnard, and Santa Paula, where they're like, oh, okay, whatever, I'll deal with community laundry. It was like, no. And so I was like, oh, you like totally nailed that on the head, because we were like, oh, we're not going to do that. Yeah. But that's where I was like, oh, no, that's worth the money.
Yeah. No, there's some things worth the money.
Yeah.
For sure.
Yeah.
100%.
No, I get what you're saying. So before we get to final thought, I have to ask this question, and it's kind of a two-part, but whoever wants to, or both. Where do you see multifamily over the next 2-3 years? Is there a buying window, and are rates coming down? That's 3 questions.
That's
Sorry, repeat those one more time.
So where do you see multifamily in the next 2 to 3 years?
Yep.
Is there a buying window now? I guess we're talking locally. And interest rates, are they coming down?
I mean, I can answer. Rates are 100% coming down, in my opinion. I'm always wrong on rates, but
our crystal ball has been very blurry on rates for the last 5-6 years.
I want to say that Trump is so focused on bringing rates down, and if you believe what he says, which maybe is a hard thing, rates are coming down. You've seen it, so I think we're gonna have to also, because there's just some structural issues. It's a great time to buy. If I had to say we're in a cycle, we're in the first inning. You know why? Because the last 4 years has been a real kick in the butt. Like, so hard. Rents going down, vacancy issues, OpEx, headline risk, fraud, COVID. Like, we can keep going. And if, like, we had a mantra, survive till 25, which I don't think was a good mantra, because that
started in 21, by the way. So
that
we thought 20
21.
years, surviving in 25 makes sense.
But what we're seeing is that this is a beginning of a new cycle, that things are repriced, that you can get really nice yield on assets, like you were talking about it earlier. And we're in a window where I think OpEx is going to come down and revenue can go up. And that's a good dynamic for multifamily.
So I have to say this. I'm a Patriot fan.
Sorry to hear that.
They were down Super Bowl, Atlanta. They're down 28-3 in the third quarter. Okay. And Tom Brady's over there getting his guys roused up, this and that. And the last thing he said, he goes, "This is going to be one hell of a story." And that's my mantra. This is going to be one hell of a story that I'm going to tell.
Yep. And if you've made it the past 5 years and you're above water and you're operating, that's already one hell of a story.
Yeah.
If you can now take what I think is a very new value-add environment, it's no longer we're the only ones doing it, now everybody's doing it, and you make it the next 5 years, it's another good story. I would just be cautious of getting ahead of ourselves in the value add game. I think what I've seen the past 5 years is that, like we've said, like that delta, that arbitrage, like markets have really changed, and it's just not there the same way that you think it is. And I think, being bullish on rent growth and bullish on new incoming rents, like you got to be. I'd rather you buy less and be more spot on with your pro formas and to your investors than go out on a tear in what we think is the first inning of a new cycle and then be back in the same boat in 2 years.
The other thing I'm saying to folks, and this is crazy, but the markets move so quickly. So like back in the day, and I don't know because I wasn't back in the day and neither was Jordan, but like apparently back in the day, 30, 40 years ago, market cycles were pretty slow and they evolved and you had a cycle and it was over years. It feels like our market moves almost by month. And AI and technology are having a lot to do with it. So, we try to be adaptable. So you got to, because the market's moving so quickly. What worked 6 months ago may not work today. So that's a realization that I think everyone should have. And the other thing is that you really need to pay attention to your macro and micro environments. So if, for instance, we bought in Hollywood, right? The writer's strike really killed us. It just really did. And, it was something that I thought was not going to be as persistent as it was. That's a very micro thing in one of the markets that we own properties in. But it was a problem.
Or the crime and homelessness. Like we probably could have hedged better in hindsight, saying like this is a market that as the world changes around it will have its issues over West Hollywood or over west side of LA. It's foresight that I don't think we could have had, but in hindsight now I would have said like we should have looked at that.
So like if your market is really dependent on, drivers that drive Uber, like you're probably not going to do well over the next 5 years. Like that's a pretty obvious thing to say today, but like it's something as real estate investors we really need to think of who's our tenant base, how's AI and other things are really affecting the micro environment.
Well, that's like us with ICE.
That's right.
Because
I want
we
to
have
pump
huge agricultural, like Ventura County, that's one of our largest
100%.
industries. And like we had a tenant just picked up the other day. They're moving out. Like, what am I going to do? Say to the woman that, no, sorry, you're stuck in your lease?
No.
Absolutely
like,
not.
So that's like what I realized just like micro, like right here.
But I would say, and this is a pump up for California, specifically LA, is that if you're going to buy in an environment that could dramatically change from AI and job growth and office space and all the things that are drivers for rental properties, is find a forever market.
Yes.
And I think we are full believers that people have to be here.
Yes, I
Period.
agree.
It's not a matter of wanting. It's for whatever reason in their life, they have to be here. Unlike Indianapolis, which is a 7 cap market and people are doing all a whole slew of things could dramatically change in the next 24 months that makes that a market where you can't lease apartments.
I mean, Newsom had his State of the Union, kind of like Trump, and I didn't take much out of it. But one thing I did take out of it was California's the 4th largest economy in the world now.
Yes.
World, guys.
Wow.
Yes.
So,
And that's
includes
what a lot
all
of people-
countries.
That's when people are like, oh, you guys are losing population a lot. I'm like, do you
It's
understand?
my favorite conversation. I'm like, do the numbers, dummy.
Oh my
like
God.
we're talking like 0.0000001% of the population.
Well, and then I always love
And they're not
like,
our renters anyways.
Yeah.
But
Exactly.
also it's like we have 40 million people here. The next largest state is 20 million. Like, because my kids will be like, oh, someone said da-da-da. And I'm like, percentages don't work when you're talking about California. Our percentage will always be higher. We're double the population.
Yep.
And I said, that's what you have to watch with.
So we got to
percentages.
get Jordan to soccer. So final
Let's do
5
it.
real quick. Whoever wants to answer, best deal you've ever done.
Can I go?
yeah, sure.
It's the deal we just bought, I think. We've done some great deals, but I am never been more excited about. We just bought a 76 unit building in Gardendale. I'm sorry,
Well, I was like, what is
Sorry, it's on Garda. In Paramount, Downey, at the border.
Okay.
We love these markets further south.
Yeah.
It is a steady, awesome workforce housing community. Single family home prices are north of $600,000-$700,000. They have incredible retail, very mom and pop ownership market. We bought it almost at a 6.25 cap. This is where Mark comes in. We had a whole value add business plan, $25,000 renovation budget, increasing rents by $500-$600. And I'm not kidding. We had to close soon, and we were in the last rounds of fundraising, and we looked at the model again and was like, wait, what if we just increase rents by 3%? The market historically has increased by 51% in the past 5 years.
Yeah.
So it was like, all right, we're going to do this business plan, and for the first time in our lives, we're going to have a cash flowing asset day one. To your point, 2 years of stabilization eventually leads to an annoyed investor base.
Yeah.
And then I have to do that over and over again. And so we went into 6.25 cap, 5.5% debt, 70% leverage. And we just distributed our first quarter after closing.
That's awesome.
So like, A, we had size and scale. B, we have a type of tenant base that's sticky and isn't looking to leave and it's willing to take an increase. And we're not putting a gun to our head and we're saying like, I just want 3%.
That's small.
Yeah. What some of the things we're telling on the podcast, we're listening to ourselves. Like we actually said and looked at each other and said, let's do less.
Yeah.
Yeah.
And that took 5 years of getting ourselves re-engineered to say like, do less.
Yeah.
Like we fought so many times in our lives being like, I'm not doing less.
Yeah.
Like I'm doing the tile in the shower. It's like, well, but why? Right?
Yep.
Yeah. One day we'll be there.
I don't know. I might be underwriting things totally different now.
Biggest mistake that made you a better investor?
I mean, this is easy for me. We had a bunch of business plans where we spent way too much money.
Yep.
And if we really looked at it and said, you know what, we could have taken that $1,500 rent to $2,500, spent nothing. Instead, we were trying to go for 35 to 45, spending hundreds of thousands of dollars to get there. And we thought it was worth it because it was like in New York City when we were doing this, you got paid for it. People really cared. And it was a forever rental market that was continuing going up. It was a mistake, honestly. And it's okay. Because we have beautiful apartments and we have beautiful assets. But if I had to redo it over again, I would not have spent that money.
Good.
Sell when cap rates are low.
So
yeah, that's a good one. Yeah, that's a good one.
Like if we sold the whole portfolio in 21 at 4.5 cap, it would have been a different story.
Wow.
Yeah.
One book that changed your mindset, or a book that you guys,
recommend. I read a number of like leadership type of books. And it's like a lot of these are military driven. Like if you go to Lone Survivor, there's a couple of these guys that have written really nice books. Like a lot of what we do is leading people, whether that's your general contractor or the subs or your property manager or the people within your own organization. And I think we get into as owner, developer, operators, we're just running through walls and we don't care about that person or this person or how the organization's being run.
Talking to me.
And we did this for 5 years. We ran as fast as we could and at the same, like not actually growing the business. And, I would say stop and like make sure your business is functioning well. Because if your business is not functioning well, your projects won't function well.
Yeah. That's awesome. So last one, if you started over today, what would you do first?
I mean, for me, I would be the vintage of what we bought would be I would never have bought anything sub 1980. That would have been, and again, the rent laws didn't change until 2019. We didn't know the difference, but we just came from a cloth of we want to do as heavy value add as we can. I would have probably done let's do less, and we wouldn't have bought as many smaller properties. Like I love our portfolio, but we have an average of 25 units per building, but we own 70 of them, and it's like. Every business plan can get into real trouble with 2 months of vacancy or that one eviction. By the way, that one eviction that took us 9 months to get the guy out in a 12-unit building, distributions are gone. So size is important. Vintage is important.
Yeah.
Jordan took the words out of my mouth. Size. Like it's hard, right? Because when you've never done this, right? And you've never raised money and you've never done it, you're going to start smaller, right?
Yeah.
But I think we could have taken some of our track record after we did it 10, 20 times and then automatically said, okay, now we're doing it. We're pretty disciplined now. Like we were in a meeting before we got here today and someone was like 25 units. I said, no, too small.
We're too disciplined.
Yeah. What's the minimum?
Unless we own 50, in that
50.
area.
Yeah. I think
if
50.
we own on the block, we'll buy a 35 unit building.
Okay.
But 50 and that if you want to make that's how we really make more money is in these bigger deals.
Yeah.
Yeah.
And the stress is a lot less.
Yeah. I like
It was
that.
funny. I was on a phone call today with a big time guy, 60,000 units. And we were having kind of this conversation. And he said something really interesting that I hadn't heard before. He says, I have a unit cap. I said, excuse me? He's like, yeah, I won't buy over 400 units in one property. He's like, it actually becomes too big to manage. And it's too difficult. And you're almost not even doing an apartment complex. You're doing like a little like neighborhood all of a sudden.
Oh,
And it
wow.
made me think. So he's like 200 to 400. And I was like, oh, that's kind of interesting.
Yeah.
I was like, because
Never heard that
we're
one.
talking about size, but he was talking about size in the opposite category. Anyway, it just made me think of it.
Yeah. Well, Mark Jordan, seriously, honestly, thank you so much for coming.
Thank you guys for having us.
Thank
First
you.
of all,
So
kudos to what you two have built.
Oh,
We've had the benefit of kind of from our lender lens, see
Yeah.
what you've done. You guys are excellent operators. You're
Thank
a
you.
great yin and yang, which
thanks.
partnership, we didn't say this enough. Partnership is everything.
Yeah.
Mhm.
I could never do this alone.
Yeah.
I'm not
100%.
always right. He's not always right. Two minds
She's
think
always
better than
right.
one.
Oh, yeah.
And we really appreciate the opportunity to be here with you guys.
Yeah.
Yeah. No,
it's-
you guys have been great.
yeah.
I really appreciate
Yeah.
your
So
relationship.
here's to, many more. This was an incredible conversation. It really was a masterclass.
Yeah.
I'm blown away. I'm going to watch it over and over. Structure, execution, what it takes to actually deliver a business plan in today's market. So I really appreciate like the transparency. You guys were so transparent, real world insights. You both shared, especially from the ownership side of like Bold Partners and then the lending side of Sunday Capital. For operators like us who are in the trenches every single day, this type of perspective is like so valuable. And personally, I want to just say thank you for the partnership as well. Thank you, Mark Schillinger, for the introduction. Marissa and I are generally like look up to you guys
Yeah.
and are
It's
grateful
great.
to be working together. You're our go-to financing team and lending partners. And to everyone listening, if you got value from this episode, I know you did. Make sure you subscribe, share the episode with another operator or investor, and send it to someone who actively is in the game right now. So because of conversations like this, it's not just theory. This is a real deal, real execution, real experience. Thank you for tuning in to Ladders and Leverage. We'll see you on the next episode.